When I was working on the script for this video, I had a subscriber post that credit scores are, quote, made up BS to keep people wage slaves. On the one hand, I can understand why people might feel that way. On the other hand, it's also just completely wrong. I'll get there in a minute, but first I want to start with a thought exercise. Let's say your brother asks you to lend them some money. Do you lend it? The answer to that question is probably determined by multiple factors. Do you have the money to lend? Is your brother trustworthy and reliable? And does he make enough money to pay you back? This is the mental math you're doing, whether you realize it or not, when deciding if and how much you might lend. Guess what? Credit rating agencies are doing this math with you too. You've been reduced to a credit score and a credit report. Lenders literally have your number. This is a special crossover episode where I explain credit scores and credit rating agencies. And I also get to ruin credit repair services. I love to give dad explanations, and this is a topic I've done dad duty on several times over the years. But I also love exposing scams. And this topic lets me do both. Looking back, money lending has always involved some way to assess ability to pay and the risk to the lender. In the past, especially at community banks, loan officers often knew borrowers personally. They knew your family, they knew where you worked, and they knew whether you were reliable. That system didn't scale. It also didn't work well for people who moved between cities or states. And let's be honest, it was absolutely riddled with bias and discrimination. So let's talk about how we got from that to the modern credit system. Credit reporting didn't begin as some secret corporate conspiracy. In the late 1800s, merchants began informally sharing information about customers who didn't pay their bills. These were local systems, often with handwritten ledgers, used to reduce losses. As the U.S. economy expanded and consumer credit became more common, this informal sharing turned into businesses. By the early 1900s, credit bureaus existed in most major cities. They collected payment histories, employment information, and personal details. Fast forward to the mid-20th century. As national banks, credit cards, and installment loans became common, lenders needed standardized, scalable ways to evaluate borrowers they'd never meet. This led to the consolidation of credit bureaus into the big three: Experian, Equifax, and TransUnion. These companies don't lend money. They don't approve loans. They collect data and sell risk assessments to lenders. The most important thing to know is that these bureaus are legally regulated, largely by the Fair Credit Reporting Act passed in 1970. The FCRA establishes rules around accuracy, consumer access, dispute rights, and permissible use of credit data. This regulation isn't perfect, but it's an important check on the power and discretion of companies that are running around with some of your most important information. The regulations aren't about protecting banks, they're about preventing abuse. Most people are aware that they have a credit score. Many even know what theirs is. The number isn't a secret, and it's commonly shown to people in their banking and credit card portals. And while most people have some idea of what the common range of scores is and what's considered good, they typically don't know how it's calculated or what the number is meant to signify. Your credit score is not a single thing, but it is a single number, between 300 and 850. The score ranges are on the screen. The score is a statistical estimate of how likely you are to miss a payment, based on patterns observed across millions of borrowers. Different scoring models exist, but they all use roughly the same categories. Payment history. Have you paid your obligations on time? Amounts owed. How much of your available credit are you using? Length of credit history. How long have you been borrowing and repaying? Credit mix. Do you manage different types of credit responsibly? And new credit inquiries. Are you rapidly seeking new debt? You may be thinking, if there are different credit bureaus, are the scores all the same? And that's a good question. You see, Experian, Equifax, and TransUnion all use FICO's credit scoring formulas to calculate the actual credit scores. There can be slight variations because the underlying data at those agencies can be a little different. To make it a little more confusing, there are different FICO scoring models, depending on what kind of lending you are seeking. For example, FICO 8, FICO 9, FICO Auto, and FICO Bank Card. If you want to get even more confused, the credit bureaus have introduced another rating score called VantageScore. Did we need another credit scoring system? Probably not, but this one is the one that credit bureaus don't need to pay FICO to use. So that tells you much of what you need to know about why it exists. VantageScore has been around since 2006, and lenders still pretty much only use FICO scoring. And that should tell you how unimportant VantageScore really is. Regardless of what credit score you have, it doesn't measure morality. It doesn't care if you're a good person. It just cares if your past behavior looks statistically similar to people who defaulted in the past. This is critical to understand. Your credit score is not a judgment of your worth. It's a probability model that requires data and time. So how does information become part of your credit report? Your credit report is a database entry, not a diary. Lenders, utilities, collection agencies, and courts report information when they have a permissible purpose. This includes opening an account, making payments, missing payments, accounts going to collections, and judgments and bankruptcies. No one needs your permission to report factual information about a debt you incurred. Errors happen, but they are not super common. And importantly, negative information doesn't appear because someone dislikes you. It appears because a reporting entity says, this obligation was not met. If you want to know how your credit score and credit report are used together, this may help. Your score is a summary. Your report is the detail. Lenders use both. The score determines eligibility tiers: approved, approved with higher interest, or denied. The report determines conditions: down payment size, interest rate, collateral requirements, or manual review. Two people with the same score can get different loan terms based on what's inside of their reports. This is one of the reasons why credit repair gimmicks that focus on boosting your score miss the point entirely. In case you think that this doesn't apply to you because you aren't borrowing any money, think again. Credit checks aren't just about loans. They're used to assess risk in situations where you receive something before you fully pay for it. That includes cell phone plans, utility services, apartment rentals, insurance pricing, and even employment background checks in some industries. In instances where you receive services before you pay, the company wants to know if history suggests they'll actually be paid. This isn't about punishment, it's about loss prevention. There are competing goals of credit rating companies, and credit bureaus and scoring models operate under tension. On one side, they need scores to accurately predict risk. On the other, they need enough people to be score eligible for lenders to keep buying their products. If standards are too strict, too many people become unscorable. If standards are too loose, default rates rise. This means that scoring models evolve, not to help borrowers, not to help banks, but to keep the system statistically accurate. It's not personal, it's just actuarial math. Outside of the scoring is where the corruption happens. For example, the system is exploited when salespeople and lenders commit fraud to conceal the true risk of a buyer or borrower. It's also exploited when borrowers lie about their income or liabilities. Credit damage usually isn't dramatic. It's boring. Missed payments, high utilization, accounts and collections, medical debt, divorce or job loss. And here's the uncomfortable truth. People with good financial habits can still have bad or incomplete credit. If you avoid debt entirely, you may have no score. And this can feel unfair, as you don't have a history of irresponsibility with money, you just don't have a positive history of repaying debt obligations. Similarly, if you pay for everything in cash, lenders have no data. If you co-signed and somebody else defaulted, you eat the damage. The system measures behavior, not intent. Now we get to the fun part. What do you do when you've damaged your credit? Well, I said that data and time are used to turn your credit reputation into a number. Generally, when you have the need for good credit, you don't want to have to wait to fix it. That's where credit repair services like Lexington Law, CreditRepair.com, Credit Saint, Sky Blue Credit Repair, The Credit Pros, and SafePort Law come in. These companies promise things like remove negative items, boost your score fast, fix errors lenders don't want you to know about. But here's what they actually do. They have you dispute accurate information repeatedly. They delay collections temporarily. They charge monthly fees for actions you can do yourself, and they give vague advice wrapped in urgency and fear. They cannot legally remove accurate information. They cannot override reporting requirements. They cannot hack the credit system like it's the Matrix. Worst of all, these companies portray broken credit as something that can be fixed, when it usually accurately is measuring a person's economic misfortune. And the most important thing to know is that these companies can't legally do anything on your behalf that you couldn't do yourself, and you could have done it for free. Many deceptive credit repair companies don't just fail to help, they push practices that are illegal or dangerous. Credit repair is one of the most litigated consumer finance niches in the US. Many firms have been fined or shut down for charging upfront fees. Federal law prohibits credit repair companies from collecting money before services are actually performed. Some firms disguise this as consultation fees or other upfront charges. But however it's pitched, it's illegal. Guaranteed results or quick fixes. No reputable company can guarantee negative items will disappear or your score will hit a specific number. That's illegal under the Credit Repair Organization Act. Encouraging false reports or fraud. Some scammers have told clients to file false identity theft reports or police reports, or lie in disputes about accurate debts, which is identity fraud. Don't let clowns talk you into breaking the law. Selling new identities. Perhaps the most notorious scam tactic is offering a credit profile number, or CPN, or an EIN that is a fresh start number to replace your social security number on credit applications. Does that sound like fraud? It is. A CPN is normally an employer identification number, or EIN, but that's only for businesses. Behind door number 2, a stolen social security number, often from minors or the deceased. Using a number other than your own social security number to apply for credit is misrepresentation, fraud, or identity theft. If a lender thinks they're dealing with one person, but it's actually an alternate or stolen number, that's a material misrepresentation, and it can land you in serious legal trouble. Worse, it probably won't matter if you were scammed into it. If you want to know how it's marketed, shady companies advertise CPNs or credit identity resets like erase negative marks forever, build a perfect credit history, start with a clean credit slate. None of these are legal or legitimate uses of a number, and any lender discovering this could revoke credit or pursue legal action. Fake credit card offers. While credit repair companies typically don't sell fake credit cards directly, some scams are tied into broader schemes that sound like it. Scammers may promise a new credit profile along with a pre-approved card tied to the CPN, or they offer secret credit cards that supposedly don't require a social security number. Those are almost always bogus offers. They either lead to identity theft, lead to accounts being opened under stolen numbers, or they just take your money and disappear. By law, banks require a valid social security number, or ITIN, to issue real credit cards. So any offer that tries to substitute a CPN, EIN for a genuine consumer credit account is illegal or fraudulent. The creativity of the scams doesn't stop there. What's most common in the shady credit repair world is someone literally co-signing a credit card you can't use. You're added as an authorized user on someone else's credit card account, usually through a broker or credit repair service. Here's how it works. Generally, you can have an authorized user or cosigner. The cosigner signs the credit contract with the full legal responsibility and usually gets access to the account. This requires authorization and a signature. But that's not you. An authorized user is simply added to an existing credit card account by the primary cardholder. You don't get legal responsibility in most cases, but the account's history can show up in your credit file. Some companies market a service where they will add you as an authorized user to a creditworthy person's long-standing credit card account so your score will improve. This is sometimes called piggybacking. This isn't necessarily illegal if done legitimately. Authorized user status itself is a legitimate part of credit reporting, but some operations sell access to trade lines without clearly telling you what you're getting into. They may charge large fees for something you could do yourself that doesn't ultimately help you. In rare and more extreme versions, scammers might try to mask the arrangement, misrepresent it to lenders, or imply that you have spending access when you don't. Shady and fraudulent variants are paying for piggybacking on a stranger's accounts. This is the classic paid Tradeline scam. Company claims that they have a network of cardholders who will add clients as authorized users for a fee. But the reason why this is problematic is some lenders frown on this practice or have started to discount trade lines that they know are sold for this purpose. In certain cases, the arrangements might be structured in ways that could mislead a future lender. If they think the authorized user is genuinely linked to the primary account holder when in fact the linkage was transactional. There have been enforcement warnings around selling trade lines as a secret score boost. But be careful. No legitimate credit repair company can guarantee that this will work. And if they obscure what's happening or encourage you to rely on it to obtain credit under false pretenses, that's trouble. There are cases where someone's name ends up on a credit account without proper consent. This is real fraud, not just credit repair smoke and mirrors. If someone attaches your personal information, your name, social security number, or anything else to a credit account you never agreed to, that's identity theft. Opening or associating accounts in your name without consent. Something that can negatively affect your credit and something that you should dispute with the credit bureau immediately and often report to law enforcement. This isn't a legitimate credit repair practice. It's a crime. Some of these businesses operate legally, but ineffectively. Others operate legally until they don't. And they almost always end up costing people more money while delaying real solutions. Want receipts? I'm putting them on the screen now. But these things pop up all the time. So there's no way I can tell you all the companies involved. But I can tell you how to spot and avoid the scams. Red flags that often show up with shady credit repair operations are claims of instant fixes or specific score guarantees, upfront payment demands before services are rendered, no written contract explaining rights under the CROA, suggesting that you use fake identities, CPNs, EINs, or file false disputes of accurate information, and promising the removal of accurate negative credit history by magic. If you see any of those, it's a strong signal that the company is either shady or outright illegal. The age-old test still applies. If something sounds too good to be true, it probably is. Well, all of that was scary. Some of the variants of the scams were ones that I'd not even heard of before. Credit repair scams exist because people with damaged credit generally want to fix it fast. So if shady credit repair companies don't work, and some of them are actively harmful, what are you supposed to do? The good news is that there are legal, boring, effective alternatives. The bad news is that none of them sound exciting enough to sell on Instagram ads. Let's go through the options that actually help people and why they work. Nonprofit credit counseling organizations. The gold standard here is nonprofit credit counseling. These organizations don't promise miracles. They don't erase your credit history. They don't sell shortcuts. What they do is help people to stabilize their finances, which is the only thing that fixes credit long term. A legitimate nonprofit credit counselor will review your full financial picture, help you create a realistic budget, explain what's hurting your credit and why, negotiate with creditors when appropriate, and help enroll you in a debt management plan if needed. A debt management plan, or DMP, is not debt forgiveness. It's structured repayment, often with reduced interest rates and fees. You still pay your debts, you just stop bleeding. That's why these programs actually work. If you want to know how to actually find one of these programs, look for organizations affiliated with groups like the National Foundation for Credit Counseling, the NFCC, Financial Counseling Association of America, the FCAA. These groups require member agencies to follow strict rules about fees, disclosures, and consumer protection. They're not paid based on how desperate you are. They're paid to help you stop making the same mistakes. That incentive structure matters. Free and low-cost credit report monitoring. Another thing scammy credit repair companies love to gatekeep is credit monitoring. They'll act like checking your credit is some arcane process that only professionals can handle. It isn't. You can legally get credit reports for free from all three bureaus through annualcreditreport.com. No subscription, no upsell, no credit identity concierge, just your data. Monitoring your credit report lets you catch factual errors, spot identity theft early, and see what accounts are helping or hurting you. That alone eliminates half of the justification for credit repair services. Due to a rule change a few years ago, everyone in the US is eligible for a free credit report every week. Don't come for me in the comments. Yes, I'm 100% completely sure about this. To be clear, I don't think you need to check it that frequently, but your frequency may be pretty high when in dispute and repair mode. And speaking of disputes, there's a key distinction scammers rely on you not understanding. You have the right to dispute inaccurate information. You do not have the right to delete accurate negative history. Real help looks like this: reviewing your report line by line, disputing factual errors only, providing documentation when required, and accepting the outcome if the item is verified. Nonprofits will help with this process, but they don't promise results that they can't legally deliver. That honestly is how you know that they're legit. If you find an account you didn't agree to as an applicant, cosigner, or authorized user, file a dispute with the credit bureau. Contact the lender to deny consent and consider a police report and an identity theft affidavit. These steps help clear your name and protect you legally. If your credit is thin or damaged, rebuilding means creating a new positive history, not erasing the past. Two tools actually work. Secured credit cards. You put down a deposit, that deposit becomes your credit limit. You use the card lightly, you pay it on time, you keep utilization low. It's boring, it works. If it sounds like a debit card, it very much is similar to that. Credit builder loans. These are small installment loans where money is held in escrow while you make payments. You don't get cash up front, so there's no risk to the lender. You get credit history. Banks and credit unions, not Instagram influencers, offer these products. There's another legitimate option I didn't know about until I was researching for this video. Some services let rent, utility, or phone payments count towards your credit history. These don't remove negative items, but they do help build positive data. Used carefully, they can help people with thin files establish history without taking on risky debt. Depending on what you report, there can be a cost associated with this. While the payment history will show up in your credit report, it may not be counted towards your scoring. That said, payment history is the largest component of a composite score, so it's at least worth reporting your rent for free. Again, slow, boring, and potentially effective. But sometimes you have to know when a lawyer or bankruptcy counselor is the right choice, and the honest answer is, you can't fix this with budgeting alone. If someone is facing lawsuits, wage garnishment, repeated collections, and medical debt spirals, then talking to a consumer bankruptcy attorney or certified counselor isn't failure, it's risk management. Unlike credit repair companies, attorneys are legally bound to act in your interest. They don't sell hope, they explain consequences. That's a feature, not a bug. And the reason why these options don't look like scams is, taken together, it's easy to spot what all legitimate options have in common. There are no guarantees. There are no urgency tactics. There are no fake identities. There are no secret loopholes, and there's no new credit profile nonsense. They focus on behavior, not cosmetics. Credit repair scams exist because people want the scoreboard changed without playing the game. The real solutions are boring, but they work. You build credit by opening a basic account, you use it lightly, you pay it on time, and you keep balances low. You repair credit by addressing the underlying debt, settling or paying the collections, rebuilding with secured or starter accounts, and being patient. And then to monitor credit, you pull your reports at least quarterly, dispute factual errors only, and freeze credit when not applying. No subscription required, no magic buttons, no shortcuts. So that was a lot. Talks with Dad can sometimes be awkward, uncomfortable, and seemingly take forever. Hopefully the takeaway is that credit scores aren't made up BS. They're imperfect tools used to answer an ancient question. If I lend you this money, will I get it back? When risk is assessed accurately, lending becomes cheaper for everyone except for the riskiest borrowers. New models exist, like microlending and over-collateralized decentralized finance, but large-scale lending isn't going anywhere. It still requires trust or profit high enough to justify the risk. Scam credit repair targets people at their lowest point, offering hope while delaying accountability. And now, you know their tactics and how to protect yourself from people pretending that they have a shortcut. So with all of that, I hope that credit scores make more sense to you. I mean, this is an important topic, but sometimes it just helps to hear things from Dad, even if I'm not technically your dad. If you know someone who could stand to hear some boring real talk on credit scores, credit reports, and credit repair, please share this video with them. If you like this video, you should hit like, subscribe to the channel, and hype this video. Have a wild credit, identity theft, or credit repair story? Drop it in the comments. Thanks for watching this special Dad Ruins, Dad Explains crossover episode. Have an awesome and well-financed day.